You just bought something you didn't need. You know this. You'll admit it privately. But if I told you that you're not weak-willed, you're not impulsive, and you're not undisciplined, what would you say? What if I told you that your brain is literally designed to make this exact decision over and over again? What if the real problem isn't you, but rather you don't understand how your brain processes money? This is what separates wealthy people from everyone else. Not their income, not their education, not their luck. It's their understanding of behavioral finance, the psychology of spending, and the cognitive biases that run their financial decision-making on autopilot. Your brain evolved in an environment of scarcity, where you had to find food, compete for resources, and survive day to day. Your ancient brain is still running that same survival software in a modern economy of abundance. That's the mismatch. That's where financial mistakes come from. Most financial advice focuses on the mechanics. Make a budget, track your spending, automate your savings. This is necessary, but it's incomplete, because you can follow all those rules perfectly and still make terrible financial decisions. You can have a budget and still overspend. You can track your spending and still buy things you regret. You can automate your savings and still feel like it's not enough. The real issue is deeper. It's about how your brain values money, perceives risk, and makes decisions under emotional pressure. In the next 18 minutes, we're going to walk through 7 cognitive biases that are costing you hundreds of thousands of dollars. And more importantly, we're going to show you the systems that wealthy people use to bypass them entirely. Let me start with the most powerful bias in behavioral finance. Researchers call it loss aversion, and the numbers are dramatic. A study published in the Journal of Political Economy gave participants a simple choice. They could either avoid a loss of $100 or make a 50-50 bet where they'd either win $200 or lose nothing. Both options had the same expected value mathematically, but 92% of people chose to avoid the loss. They would rather accept a guaranteed loss than take a 50-50 chance. Here's the kicker. The researchers found that losses register in your brain 2.25 times more intensely than gains. Losing $100 feels 2.25 times worse than winning $100 feels good. This is not a small difference. It's a ratio that rewires your entire financial decision-making. What does this mean in real life? It means you hold losing stocks too long. You bought Apple at $150 and it dropped to $130. You hold it because selling it means realizing the loss. You feel the pain of that loss more acutely than you'd feel the joy of a 10% gain. So you wait. And wait, and sometimes the stock never recovers to your purchase price and you've locked in an opportunity cost. It also means you're biased toward the status quo. Your brain protects what you already have more fiercely than it pursues what you could gain. This is why people stay in bad relationships, bad jobs, and bad investment decisions. The pain of change feels worse than the pain of staying put. When you get a raise, what happens to your savings rate? For most people, it decreases. Your expenses rise to match your new income. This is lifestyle inflation. It's also called hedonic adaptation. The research on this is clear. When someone's income increases by 10%, their spending increases by roughly 8 to 9%. They don't save that 10%. They consume it. The reason is psychological. Your brain has an internal set point for what constitutes a comfortable lifestyle. When your income rises, your brain adjusts that set point upward. You start spending more on housing, food, transportation, entertainment. Before long, you're making 50% more than you did 5 years ago, and you have less savings than before, not more. This is why you see stories of lottery winners going broke, or athletes who earn tens of millions of dollars and end up bankrupt. It's not that they're stupid, it's that their brains adjusted their lifestyle expectations upward along with their income. The solution is not to fight this bias, it's to automate a portion of each raise before it hits your checking account. If you get a 10% raise, automatically funnel 7% of it to savings and investments before you ever see it in your spending account. Out of sight, out of mind. Your brain won't adjust its lifestyle expectations for money it never sees. You value money today more than money in the future. This is called present bias, or temporal discounting. It's not irrational, it's hardwired into your reward system. When you think about getting $100 today versus $100 next year, your brain perceives them as completely different. The $100 today triggers dopamine. The $100 next year is abstract, it's theoretical. Your reward centers treat it as less real. Psychologists have measured this bias very precisely. Most people would take $60 today rather than $100 a year from now. That's a 40% discount for waiting just 12 months. If you extrapolate this across a 30-year career, present bias is catastrophic for long-term wealth building. It explains why people don't save for retirement. It explains why they don't invest in their education. It explains why they make the immediate financial decision instead of the optimal long-term decision. They can feel the pain of not buying something today, but they can't feel the benefit of not buying it. The wealthy overcome present bias through automation. They don't rely on willpower. They set up automatic transfers that move money to retirement accounts and investment accounts before they see it. This removes the need to choose between present consumption and future wealth. The system chooses for them. When everyone around you is doing something, your brain perceives it as safe. This is herd mentality. It's a survival mechanism that was useful when humans lived in small tribes. The crowd was usually right. But in markets, the crowd is often wrong. Research on market bubbles shows a clear pattern. New investors see other people making money, so they invest. As more people invest, prices rise. Higher prices attract more people. Eventually, the crowd is buying at the peak, just as smart money is selling. Then the bubble bursts. Prices fall. The crowd panics and sells at the bottom, just as smart money is buying. This happened with tulips in the 1600s, tech stocks in 2000, cryptocurrency in 2017. Meme stocks in 2021. The pattern repeats because human psychology doesn't change. Your brain sees the crowd moving, and it releases stress hormones when you're not part of the crowd. Your amygdala creates a sense of FOMO, fear of missing out, that overrides your logical decision-making. The solution is not to ignore the crowd, that's impossible. The solution is to have a predetermined plan that you commit to before the crowd takes over. Warren Buffett has a famous quote, "Be fearful when others are greedy, and greedy when others are fearful." That's not a description of his temperament, that's a description of his investment plan. He knows in advance what he'll do when the crowd is going crazy. The first number you see sticks in your brain longer than logic. This is anchoring bias. You see a watch on sale for 40% off. The original price was $500. Now it's $300. Your brain sees that original price, and even though you know prices are set by retailers, your brain anchors to that $500 figure. You feel like you're getting a deal, a good deal. But the actual value of that watch might be $150. You would never pay $150 for it if you'd seen that price first. Retailers use anchoring constantly. They show you the crossed out price and the sale price. They show you a competitor's higher price and then their lower price. Your brain anchors to the first number and makes the second number look good by comparison. This bias shows up in investing too. You buy a stock at $50. It drops to $35. Now, when you look at it trading at $42, your brain anchors to the $50 purchase price. You see $42 as still a loss compared to where you bought it, even though $42 might be a fair price and likely to go higher. You hold the stock waiting for it to get back to $50, even though the optimal decision would be to sell at $42 and redeploy that capital. The fix for anchoring is awareness. When you see a big original price next to a sale price, pause and ask, what is the actual value of this item? Not the retailer's claimed original price, the actual value. What would you pay for it if that original price didn't exist? Anchoring happens automatically. This deliberate mental pause partially counteracts it. You paid $3,000 for a weekend seminar about real estate investing. You've gone through half of it, but you're realizing it's not for you. The material is generic, the instructor is boring. You don't want to become a real estate investor, but you're halfway through. You're already out $1,500. So you finish the seminar. You wasted another $1,500 of your time and attention because you made a sunk cost error. A sunk cost is money that's already spent. It's gone. It cannot affect a rational decision about the future. But your brain treats sunk costs as a reason to continue investing in a bad decision. This shows up everywhere in personal finance. You bought a stock that's down 40%. You held it for 2 years. Now you could sell and move the money into something better. But you can't bring yourself to do it. That $10,000 loss you'll realize feels worse than the opportunity cost of holding a bad investment. Your brain is treating the sunk $10,000 as a reason to keep throwing good money after bad. It shows up in relationships too. You've invested 10 years in a relationship that isn't working. The sunk cost of those 10 years makes you reluctant to leave, even though leaving is the optimal decision. Your brain feels like those 10 years will be wasted if you walk away. But they're already spent. They can't be recovered. The question is, do you want to spend the next 10 years in the same situation? The wealthy understand sunk costs and ignore them. They make decisions based on future outcomes, not past investments. This is why they can sell investments they've held for years. This is why they can pivot careers. This is why they can exit relationships and start over. They've mentally separated past investments from future decisions. Once you've formed an opinion, your brain works hard to confirm it. You believe Apple is the best tech stock, so you read every positive article about Apple and skim the negative articles. You believe cryptocurrency is going to be worthless, so you notice every hack, every scam, every price decline, and ignore the technological progress. This is confirmation bias. Your brain is not trying to find truth. Your brain is trying to protect your existing beliefs. When you encounter information that contradicts your beliefs, your brain creates psychological discomfort. When you encounter information that confirms your beliefs, your brain releases dopamine. You literally feel better when you're confirming something you already believe. In investing, confirmation bias is costly. You form an opinion on a stock based on inadequate information. You buy it, then you only read the positive case for why you made a good decision. You ignore the negative case. You own the stock for too long because your brain is protecting the initial decision. When it underperforms, you blame external factors. When it outperforms, you claim you were right all along. The solution is to actively seek out the opposing viewpoint. Before you invest $10,000 in anything, read a detailed article about why it's a bad investment. Force yourself to read the bear case. Let it sit for a week. Then make your decision. Most of the time, you'll find flaws in your original thesis that you missed because of confirmation bias. Now that you understand these biases, here's how the wealthy systematize their way out of them. First, automate everything. Loss aversion bias is weakened when money moves automatically. You don't have to decide to save each month, it just happens. Herd mentality is weakened when you've already decided what percentage goes to stocks, bonds, and other assets before the crowd is cheering or panicking. Second, use target date funds. A target date fund automatically rebalances as you age. When you're 25, it's mostly stocks. When you're 55, it's mostly bonds. You don't have to make the decision of when to sell stocks and buy bonds. The system does it for you. Lifestyle inflation is controlled because this asset allocation increase is methodical, not emotional. Third, write down your investment thesis. Before you invest in anything, write down why you're buying it. What problem does it solve? What's the 10-year outlook? What would make you sell it? Then lock this document away. When the price drops 30% and you're tempted to panic sell, read your original thesis. Anchoring and sunk costs are mitigated because you've made a clear-eyed commitment. Fourth, implement an annual review, not a daily one. Check your portfolio once per year. This reduces the impact of herd mentality and present bias. Markets move daily. Your wealth builds annually. Daily checking creates noise that triggers biases. Annual review creates clarity. Fifth, rebalance on a schedule. Every January, adjust your portfolio back to your target allocation. This forces you to buy when prices are low and sell when they're high. It's the opposite of herd mentality. It's mechanical, no emotion. Sixth, use a written financial plan. This plan documents your income, your expenses, your debt, your goals, and your strategy. When you're emotionally triggered by market moves or financial temptation, you read your plan. You realize you're deviating from the system. Systems beat willpower every single time. Seventh, find an accountability partner. This could be a financial advisor, a spouse, or a friend. Once a year or once a quarter, you review your finances together. The presence of another person reduces confirmation bias because they'll point out things you're overlooking. They reduce herd mentality because they can remind you of your original plan when the crowd is pushing you to do something else. The numbers tell a different story about financial success. It's not about discipline. It's not about earning more. It's about understanding how your brain sabotages your finances and building systems that work around those sabotages. Wealthy people are not immune to these biases. They experience loss aversion just like you do. They feel present bias. They're attracted to the herd. The difference is they've built systems that bypass these feelings. They've automated their wealth building. They've created rules that override their emotions. They've documented their decisions so that emotions don't cloud them later. Your job is not to become a better person. Your job is to become a better system. Build the automation, set the rules, write the plan, then trust the system to work. Because your brain, left to its own devices, will make you poor. But your brain, guided by good systems, will make you wealthy.